Hi traders, welcome back to the channel. So last time what we did, we covered commodity currencies and safe haven currencies. So if you do want to cover the previous education, it's going to be in our playlist. So let's just go straight on to using bonds and how we can trade using bonds. Okay. So the bond market is pretty much where investors will be loaning money out to governments. They will be loaning out the money at a fixed interest rate. Okay. So the bonds have yields, and those yields are what the investors are looking at, so they can essentially get some returns on their investment. Okay. Now, the first thing that we would do is we need to compare bonds of different countries to kind of see where the value lies. And when I say value, I mean, as an investor, if I need to put my money somewhere, I'll be looking at the country that's giving me the highest interest rates. I'd also put my money into bonds because bonds are safer and they're guaranteed by the government, which means that they're a safe haven, right? So this is why I put them as a safe haven currency, but in itself, it's not a currency. We're just looking at bonds themselves, but it's just to make things simpler in terms of understanding. Their bonds are the safest or the most low risk type of investment, whilst equities are looked at as a high risk type of investment. So we're talking about the NASDAQ, the S&P 500. That's where investors are looking at in terms of high risk, and investors are looking at bonds in terms of low risk. All we need to understand is the money flow. How does the money move out of the equities into the bonds, and when does it move out of the bonds and into equities? Okay. The first thing I do here, you'll be using the 10-year government bonds on all the charts, because 10-year government bonds represent the most, not only the most common, but also the most used bond asset in terms of understanding money flow. So that's what we're gonna look at. Okay. So the first thing I do, I go and compare. Now that we're in the pound USD chart, you would have to use the pound 10-year or the gilt, right? Take away the US 10-year. Now that's going to give you a chart. Now this chart is going to be different for all. Make sure that you guys pin it to the left of the scale or put it to no scale, okay? And this produces some sort of like line or some sort of like information that we need to translate, okay? The first thing I'll do is I will go onto here just to give it a little bit of a different color. Okay, something a bit brighter. Yeah, there you go. So what does this tell you? From the outset, obviously, until you understand the relationship, it's a bit harder to kind of see what we're doing here. But when you do start to understand the relationship, then it's much easier to use this for executing some trades. So what am I looking at here? I'm just going to change that to a different color. Oh, okay. So I prefer this color. So this is a better color. Okay. So as we look at the yields, we're going to look at them separately to the chart. So I'm just going to switch off the chart for now. Okay. And what we're looking at is behavior. Basically, we're looking at the 10-year. We're looking at the pound 10-year versus the US 10-year. Okay. So just by looking at the chart, just in this section itself, what we're understanding here is that the investors are more happy to invest in the 10-year pound yields than the US 10-year. Okay. Then it reaches a point around March and April where they then start moving their money out of the UK or the pound 10-year and start moving their money out of the UK and into US 10-year treasury bonds, right? And that theme happens throughout the whole of 2020 and just continues up into the 2021s, where then the theme changes and they're now happy again to put their money into the UK 10-year around September 2022. That theme doesn't last long, and around October 2022, they are now moving their money back into the US 10-year. Okay, so this relationship is always going to be on and off. It will always depend on where you're getting the highest rates of return. Okay, now how can we use this to trade? That's all I want to know. How can we use it to take trades? Okay, or high probability trades. The first thing that I would do is if I put the chart on and look at the relationship, what does it tell me? The relationship between bonds or the bond market and any currency, right, is quite visually clear, right? The high correlation. If the bond yields are moving down towards investors favoring the US 10-year, then that means money moves out of the US, out of the pound or whatever currency is going to be you're comparing with into the US dollar. Okay. The good thing is, or by looking at this, you can see that there's usually the bond yields do start to move quite fast, and then the price follows. Okay. So what the bond yields eventually, or what the bond yields allow us to see, is what we call value. And this is the difference between value trading and price action trading. Value just means that you just want to know what is the value of this item, what is the value of this asset. Okay. The value of the pound. You don't want to know what the price is for now. We just want to know what the value is. Now, to determine value, you just use the interest rate differentials between the two bonds, which means, in layman's terms, what we're saying is you just use the 10-year yields of each country against each other to figure out where the value lies. Now, as you can see over here, value started to decrease, which means the price will follow value, and it eventually does. Okay. Once value starts to bottom out and starts to increase, that is the same thing that we get in the price. So price starts to follow the value. We get to a point, the value starts to decrease again. The value of the pound US dollar, according to the bond yields, right? The value starts to decrease, and guess what? Price diverges from value, and then price eventually goes in the same direction as the value. So this price divergence is what we trade, right? So what you can essentially say as a strategy is you're just looking for when value diverges from price, and then you trade price towards value. Simple as that. So if I was looking at where we are right currently, what I can see right now is value fell, but it's now increasing, which means price in itself should actually be going up as well, because price follows value, right? But the key thing here is there's also a new theme that's going to come into play, and the new theme is going to come into play once we find out whether the Federal Reserve will increase interest rates next week, or are they going to hold interest rates, or are they going to decrease interest rates. So this is just a theme that we need to look for, especially in 2023 as the trading year goes. So as we look for high probability trades, we need to understand how to look at value first for any currency pair, and then we will now use the technicals so that we can follow price action, and price action always follows value. Okay. So if I go down to any chart, I can implement any chart on here. Let's just go with the USD CHF. Okay. Okay, so obviously we're not going to need the 10-year pound and the US 10-year for now, because we're in a different chart. Instead, we're going to go with the US 10-year minus the CH 10-year. Okay. Again, we're just going to pin it to the left of the chart, or to no scale. Change the color to something that is visible to yourselves. And you can see the relationship is actually quite interesting in terms of giving you an idea of where value lies. Clearly, as you can see down here, without picking too much, you can see as value was falling, that's when we start getting the higher highs, higher lows, and then price is kind of stagnating. The value keeps on falling until value dips, and eventually that is where price follows. Value starts to increase, right? When value starts to increase slowly and gently, price is following, and this is what we're looking for, divergence from value. Once price is falling, we start to look to follow value, which means that our price, which means now using the technicals, we'd be looking for buying opportunities just to follow value. And this is where we have to ensure that we are not trying to trade ahead of the trend or ahead of the global macroeconomic theme, which is value is increasing in this case. Okay, so as value is increasing, we'd start to look at opportunities to take long positions, right, or cut our short positions, and opportunities to get out of the market. Okay, so this is how we use bond yields. I will just do one more, an extra one. If I can just get any currency, so Euro, NZD. Okay. All right. So obviously, do not forget not to use these. Seems to be some kind of correlation between this, but we're not using this. We're just showing the simple relationships for now. So this is going to be the euro 10-year minus the New Zealand dollar 10-year. Okay. And I think, guys, you need to pretty much do a lot of practice by yourselves, backtest this to see where it fits in your strategy. But it's just a way of kind of filtering trades to the high probability direction. Okay. So here we go. You see this? Value is increasing, price follows value. Value bottoms up, or value value tops up, or value is capped at the top and starts dropping. As soon as value starts to drop, we have increasing higher highs and higher lows. So a little bit of a price discrepancy here. Okay, as we can see, high lows while value is decreasing. Again, that would be time to look at your technicals and start looking for high probability entries, because we already know you're in the direction of value. So price will eventually follow value. And this happens across all the currency pairs. So test them out, see which ones respond to bonds, bond yields in quicker, which ones take a little bit of time to respond to bond yields. And then start looking at your technical levels to support your trade as well. Okay, this is not something that you're going to use just by itself, but it's just another added filter in terms of fundamental filters. Okay, so by using this, for example, by using this, I can see that, again, first thing I always like to do is I like to switch off the main chart. Okay, so I can just see that, look, value has been increasing. It's been increasing, but again, in a range kind of bound market, but up to the upside. So that is exactly what I would expect price to do as well. Okay, so price has to follow value. It's just a simple concept. When something is valuable, then price will increase. When something is not valuable, price will decrease. Okay, so that's a concept that I want you guys to apply in your trading now. So just kind of filter and help you get better and better trades. Okay, so if I was to implement the Aussie yen as a filter to show risk on and risk off sentiment, you can clearly see that we are in like kind of a risk on environment, because we're pretty much we have moved down, but we're going a bit higher. We're in a risk on environment. So to me, this will be a no trade, because we are not really having a clear direction. Yes, the value is increasing, but it's not committing to the upside. I'll be looking at other factors, just something that I need to bear in mind in terms of the values increasing. We are in a risk on environment. So I'm going to look at another factor. Catch me in the next episode of this trading channel, where we cover how to trade using equities or indices, and how we use those to basically interpret the Forex market. Thank you for joining me, and we'll be happy to see you in the next one. Thank you. Bye-bye.